Most people think life insurance is just life insurance, but choosing the wrong type of policy can cost you thousands of dollars, leave your family underprotected, or completely miss the financial goals you're trying to achieve. Today, I'm breaking down the 4 major types of life insurance in simple language: term, whole life, universal life, and indexed universal life. And more importantly, when each one actually makes sense. At the core, all life insurance is designed to create financial protection for the people you care about. That money can help replace lost income, pay off debts, protect a mortgage, cover final expenses, leave a legacy, or even help with business and estate planning. But here's the important part: not all policies are built the same way. Let's start with term life insurance. Term insurance is the simplest and usually the most affordable type of life insurance. You choose a period of coverage, usually 10, 20, or 30 years. If you pass away during that term, the policy pays your beneficiaries. For example, imagine a 35-year-old parent with 2 children and a mortgage. They may want $500,000 of protection while the kids are growing up and the mortgage is still being paid. A term policy can often provide a large amount of coverage at a relatively low monthly cost. The downside is that term insurance eventually expires. It also does not build cash value, so term is often best for young families, mortgage protection, income replacement, and people who need strong coverage on a tighter budget. Next is whole life insurance. Whole life is permanent coverage designed to last your entire life as long as the premiums are paid. Unlike term insurance, whole life also builds guaranteed cash value over time. A simple way to think about it is like renting versus owning. Term insurance is more like renting protection for a certain period. Whole life is more like owning a permanent policy that can build value over time. The benefits are lifetime protection, predictable premiums, and guaranteed cash value growth. The trade-off is that whole life is usually much more expensive than term, and it is less flexible than some other policy types. Whole life may work well for estate planning, conservative long-term planning, final expense strategies, and people who want guarantees and stability. Now let's talk about universal life insurance. A universal life is also permanent coverage, but it adds more flexibility. Depending on how the policy is designed, you may be able to adjust premium payments, death benefit amounts, and how the policy is funded over time. For example, a business owner may have income that changes from year to year. Some years they may want to contribute more into the policy. Other years they may need more flexibility. That flexibility can be useful, but it also means the policy needs to be reviewed and monitored. If a universal life policy is not funded properly, it may underperform and costs can rise later. Universal life can work well for self-employed individuals, people with fluctuating income, or anyone who needs flexible permanent coverage. Indexed universal life, also called IUL, is a type of universal life insurance tied to a market index such as the S&P 500. But this part is very important. Your money is not directly invested in the stock market. Instead, the policy uses index crediting strategies that may include caps, floors, and participation rates. If the index performs well, the policy may receive higher credited interest. If the market goes down, many IUL policies include a floor, often 0%, which can help protect against direct market losses. The benefits of an IUL can include growth potential, flexible premiums, tax advantage accumulation, living benefits in many policies, and the ability to use the policy for supplemental retirement income. But IULs are more complex. They are not guaranteed like whole life, and they must be structured and funded correctly. IULs are commonly used for long-term wealth accumulation, supplemental retirement strategies, business planning, and people who want protection plus growth potential. Here's the simplest way to think about it. Term insurance is temporary protection at the lowest cost. Whole life is lifetime protection with guarantees. Universal life is flexible permanent coverage, and indexed universal life is flexible coverage with growth potential tied to market indexes. None of these are automatically better than the others. The right policy depends on your age, your budget, your family situation, your financial goals, your retirement plans, and your long-term objectives. If you'd like help understanding which strategy may fit your situation best, feel free to reach out. I'm Joe Alexander, an independent insurance broker with Fortress Financial Solutions. A properly structured life insurance plan is not just about death benefits. It's about protecting your family, creating financial stability, and building a stronger future while you're alive.